Just imagine that for a second. You're watching your hard-earned money just vanish overnight. The news is screaming market crash, and every single person you know is telling you to sell before you lose everything. It's a terrifying thought, isn't it? And honestly, that fear is what stops so many people from ever even starting to invest. And yet, at the exact same time, millions of people are quietly building wealth in the stock market every single day. So what's their secret? And more importantly, how can you get in on it? Well, let's pull back the curtain together and break down this whole world of investing one simple step at a time. To really get a handle on investing, we've actually got to look way back. See, the idea of buying a tiny piece of a business, it's not some new, complicated thing. It's a concept that's been around for centuries, and it was born from a spirit of adventure. I mean, just look at how things have changed. Back in the 1600s, you had the Dutch East India Company selling shares in coffee houses to fund their big sailing voyages, which was totally revolutionary for the time. Fast forward to the 1900s, and you needed to call up a stockbroker just to make a trade. And today, the entire market is right there in an app on your phone. That's a monumental leap. So, okay, you have access. We've established that. But what actually makes a stock's price go up or down? Well, it all boils down to a super basic idea you probably learned in school: supply and demand. Let's imagine there's a local coffee shop that everyone loves, and they want to expand across the country. To get the cash to do that, they can have what's called an initial public offering, or an IPO. This is where they sell off tiny little pieces of the company. We call them stocks or shares, to regular people. And when you buy one of those shares, you're not just a customer anymore. You are literally becoming a part owner of that business. And this is where that seesaw effect really kicks in. On one side, if that coffee company starts doing great and more people want to own a piece of it, demand goes up and that pushes the stock price higher. But on the other side, if some bad news comes out and investors get nervous and start selling their shares, demand drops and so does the price. It's this constant balancing act, all driven by how confident people are in a company's future. So what kinds of things can shake that confidence? Well, pretty much anything and everything. The price of coffee beans, a new CEO taking over, a bad story in the news, new government rules, and of course, just plain old human emotion. All of these things create what investors call market noise, the constant short-term ups and downs that can make the market feel really chaotic. So how do you navigate all that noise? Well, you need the right tools. Think of it like a toolkit. And for someone just starting out, there are 3 essential tools you really need to know about. First up, you have the individual stock. We've talked about this one. It's a direct piece of ownership in one single company. This gives you the highest potential for big returns. But it also comes with the most risk because all your eggs are in one basket. Your success is tied to how well that one business does. Next, you have a bond. And the simplest way to think about a bond is that it's just an IOU. You're basically lending money to a big company or even the government, and they promise to pay you back in full with a little extra interest. Bonds are way more stable and less risky than stocks, but that safety usually means you get lower returns. And finally, we have the tool that many experts say is the absolute best place for beginners to start: the index fund. Think of it like a music chart, like the Billboard Hot 100. An index, like the S&P 500, is just a list of the 500 biggest companies in the US. So, when you invest in an S&P 500 index fund, you're not betting on one song to be a hit, you're buying a tiny piece of the entire chart. And here's why that is such a game changer. Trying to pick the next big thing, the next Apple or Amazon, is incredibly hard. I mean, decades of data show that most professional money managers can't even beat the market average over the long haul. With an index fund, you don't have to pick the winner. You just buy all of them. If one company has a terrible year, it doesn't sink your whole investment because your money is spread out across hundreds of others. It is powerful diversification with literally a single click. Okay, enough theory. You get the concepts, you know the tools. Now for the most important part. How do you actually do it? Let's walk through a super simple 4-step guide to making your very first investment. Step 1. Open an account. Just download a brokerage app and open a tax-advantaged account. All that means is your money gets to grow with lower taxes. In the US, it's called a Roth IRA. In the UK, a stocks and shares ISA. Step 2. Add some money. Link your bank account and put in an amount you're comfortable investing. Step 3. Pick your investment. A low-cost diversified index fund is a fantastic place to start. And finally, the magic step, Step 4, put it on autopilot.
Set up a recurring investment so you're building wealth consistently without even thinking about it.
That last step, automation, is arguably the most powerful one. Because the real secret to investing isn't about quick wins or getting rich overnight, it's about slow, steady growth over decades. Without a doubt, your single biggest asset is time.
Let me show you what I mean with a real example. Let's say you invest just $300 a month. That's a decent chunk of change for sure, but probably not what most people would call a fortune.
But if you invested that same amount consistently for 40 years, based on the stock market's historical average return, your portfolio could grow to over $3.5 million. That is the jaw-dropping power of compounding, where your returns start making their own returns, and it all just snowballs over time.
And this is why you always hear financial experts shouting from the rooftops to start as early as you can. As you can see from this chart, waiting just 10 years to get started can dramatically slash your final portfolio's value. You miss out on a whole decade of that compounding magic when it's at its most powerful.
Which brings us right back around to that Monday massacre we started with. The investor in that story didn't panic. He didn't sell. He held on. Why? Because with a long-term strategy and a diversified portfolio, history shows us again and again and again that the market always recovers from every downturn. The goal isn't to try and avoid the storms, it's to build a ship that's strong enough to weather them.
So look, you've got the knowledge, you know the tools, and you have the strategy. You understand that the game isn't about timing the market, it's about your time in the market. The journey to building wealth really does begin with a single step. The only question left is, what will yours be?